Today, I want to talk to you about a very important concept in investing, which is called dollar cost averaging. Now, don't worry, if you're not investing in dollars, it doesn't mean you need to convert to dollars to invest, but it describes a powerful principle of investing consistently over time. That's really fundamentally it. Unfortunately, while it's so simple to understand, a lot of people don't follow it. So in this video, I want to really explain you what it is, show you even an example of a multi-billionaire following the same principle, as well as sharing how I implement it into my own investing strategy. And if you're already dollar cost averaging, give you some extra tips how you can take it to the next level. But first off, what does dollar cost averaging really mean? Well, it's basically the opposite of lump sum investing, which means you take all your money that you have at the current point, let's say 5,000, 10,000, 20,000, whatever it is, and dump it all into the market whenever you think it's a good time. So you kind of time the market and put your money there, buy your ETF, stock, whatever it is, cryptocurrency, and just put it all in there. Sounds nice in theory, right? But it's very difficult because you try to time the market. But the problem is, that is very difficult. For example, looking at Bitcoin, right? Now you can see obviously the price where it is today. But if you didn't, so the question is, when do you actually get in, right? And then if it keeps on going up, you feel like you missed out the ride. Let's say you wanted to buy here, but then the price kept on going up. And then you were saying, oh, now it's too expensive, better wait out. There was a little reset, but then it kept on climbing again. So you might have missed that entire rally. And now all the way almost missed out on doubling your money, right? So it's very difficult, and that's really about market timing. While dollar cost averaging is basically the opposite. You just continue buying no matter what. If you found your investment class that you like, any asset, right? Again, it can be ETF, stocks, whatever you want to invest in, you keep on buying regularly, consistently over a long period of time, no matter what. And that kind of takes the pressure out of trying to time and guess the market, which I think makes it perfect strategy for so many investors who live busy lives like all of us, right? We have our jobs, businesses, family life, so many obligations. Probably the last thing is you want to log in after a long day of work and try to find a market and think, should I invest today or wait till tomorrow, follow the news? It's really overwhelming. And that's why I think dollar cost averaging can be such a successful strategy. Now, which one is better long term? Honestly, it's, I think personally, really hard to say because you see a lot of different statistics, right? Whoever wants to convince you of one or the other, they will find the best statistics for their case. And obviously, if you want to make a case for lump sum investing, sure, if you always find the right, perfect timing to invest in the market, of course, then technically long term, you will probably outperform dollar cost averaging. But that's exactly the struggle, right? To find the perfect entry times basically would mean you outsmart the market, which is so difficult to do. The same with picking stocks long-term to outperform the S&P 500. We all know how difficult it is. That brings me to the example of even, as I said, multi-billionaires. In the case of Michael Saylor, who is really Mr. Bitcoin. You can see they're holding now over $70 billion worth of Bitcoin. And guess what? Look what he's doing. He's basically dollar cost averaging into Bitcoin. In this case, he buys no matter what. The price goes up. It was back in 2020. It's the Saylor tracker. They basically record all the buys he's doing. And yeah, he kept on buying under 20,000. The price was going up. He kept on buying, right? He would have said, look at this. Oh my God, the price is going crazy. I better stop buying. No, he didn't. He kept on buying on the way up. He kept on buying also on the way down. And once again, on the way up, on the way down. And now look at the price, went up like crazy. And he just kept on buying. So that's exactly dollar cost averaging. He's not trying to time the market perfectly. I'm sure he has some algorithms and so on. So he has some kind of, strategies for that. But he kept on buying. There was not a huge period of 2-3 years where he said, I'm not touching it. I believe in it as a class, and he kept on buying. And that's really so powerful. And I think that makes it so attractive. Like I said, for so many people, ideally, you just automate it and don't think about it. I always give the analogy of going to the gym, right? Some people, they go to the gym, once a week and spend there 3 hours. It's still probably better than not going to the gym at all. But ideally, you want to go 4 or 5 times a week. Even half an hour is probably still better than 1 day a week for 3 hours. It just is, right? So the same with investing. Do it regularly. And again, whether one is more successful than the other, is up for debate. Depends, once again, which statistics you read. I personally think long-term, they're pretty similar. But one big differentiation is where I really think the edge goes to dollar cost averaging. You ideally automate it and don't have to think about it. And that way the investments gets done. Because the problem is with lump sum investing, while in theory, if you time it perfectly, yes, you can outperform. But once again, you have to remind yourself to actually do it. And let's be honest, it's the same with going to a gym. A lot of people, they follow their feelings. And today I don't feel like it. Same with investing. That week you should invest your money. Well, things happen. You got busy at work, family obligations, whatever it is. And you skipped. And maybe another week and another week. And that way you spend less time in the market. And that will work against you because you want to compound your growth over time. So you got to be invested into the market to get those profitable days when you see an uptick in there. So I think that's also another big plus towards dollar cost averaging. That's why I personally really like that strategy. Ideally, you want to automate that. I'll show you in a second how you can do that with different brokers. But there's also another tip I really want to share with you, and that's the power of increasing your contributions over time. Because a lot of people, they set it and forget it, set up a certain amount, whatever they can afford. And it doesn't matter if you start with 10 euros, 50 euros, 100, 200, whatever fits for you, perfectly fine. We all, started somewhere. That's totally fine. But you got to make an effort to increase those contributions over time. So let me show you what I mean by that. Over here on the compound growth calculator, as you can see how your portfolio could potentially develop over time. I'll leave a link down in the description below so you can run your own numbers afterwards. So you can change your currency to whatever currency you use. Let's stay with euros. Initial investments, let's start from zero, clean slate. Monthly contributions, again, depends on you, but let's assume a slightly higher number of 500 euros. For some of you might be very little, for others might be a lot. So again, you can play around with your own numbers over there. Expected annual return. Let's keep it conservatively, imagining that you invest in the S&P 500. So averaged out over a longer period, that's usually the return that you could be expecting. Investment period over 30 years. I guess you're as much of a spring chicken as I am. Well, not anymore, but still, 30 years I will definitely have of investing period ahead of myself. So let's leave it there. So if I calculate the growth over here now, you would see a nice little portfolio of 745,000 euros at the end of the period. Not too shabby, right? You set it and forget it once. Very simple to do in your broker. Keep on dollar cost averaging into an S&P 500, for example, and boom. That could be potentially, it's not guaranteed. Nothing ever is guaranteed in investing, but it could be a potential scenario of your final balance. And the cool thing is, your personal money invested is only 180,000. The rest is all the growth from the investment, which is really nice. But the interesting and important part is, which a lot of people unfortunately forget, is to increase your deposits over time. Same how we are at work, right? We work harder and harder, hopefully doing a better job and get also salary increases over time. Or if you're a business owner, try to increase your profits over time so you have more money to invest. I usually like to put 5% over here. That would mean next year, instead of investing 500 euros a month, it would be 525 euros because 5% on 500 is 25 euros additionally per month to invest. Hopefully, you'll be able to do that. Again, if not, that's fine. But just, for the sake of the calculation, let's put 5%. You can put 2%, 3%, whatever is reasonable. But a lot of employers usually tend to increase also salaries by 2, 3, 4, 5%. Maybe if you get a promotion, it will be even 20 or 30%, right? So you should be able to also pass on some of the lifestyle increases that you get also towards your investment increases. And now if I calculate, if you remember, previously it was 745,000. Now you will see it hits over 1 million, 1.247 million. A huge, huge difference. Now, obviously, also your investments, almost double, but then the total interest earned is significantly more than previously. So that's what I'm saying. It's very important that you set up your investments, automate as much as possible. Again, I'll show in a second how. But also make sure you increase your allocations over time, because that's very important, right? The same way how we probably not going to be paying the same prices for eggs and milk 10 years from now, which we haven't had 10 years ago. It was much cheaper. And in 20 years, it will be much more expensive. The same, we also need to increase our allocations towards investments. Very, very important. Now, you may not be able to do that every year, but at least try to make an effort every second year or so forth. Because if you don't, your total gain will definitely be less than if you were to increase it. Especially if your starting balance is low. When you're just studying or have your first job, of course, you may not be able to even invest 500 euros, right? If you start from 10 euros or 50 euros, well, then obviously it will be much easier for you to over time increase that contribution. Now, the second part is obviously about automating your investments to the point where I said you don't have to think about it anymore. It's just done for you automatically. And for that, probably one of the easiest places to start with is Trading 212, which is also one of the brokers I use myself. I have a link down in the description below, which you can use. Check it out and open your first account and grab a free share valued up to £100 or euros. Or if you already have an account, use the code Kai to get yourself that free bonus share. And the cool thing is you can buy and sell your stocks or ETFs completely commission free, which I think is, first of all, very important, right? Because keep in mind also, the more you trade, those commissions will start eating into your profits, right? And the second thing is you can actually very easily automate recurring buys. Now, first of all, it may not be that intuitive. They call it pies, where you can set up your own investment pie, almost like a small ETF in a way. And it says over here, choose a ready-made portfolio, automate your deposits. So basically, you go ahead, say understand, and then you can either follow already existing pies, social pies from other users on the platform that have been created, or you can create your own, which I personally recommend. So you can build your own investing pie. And if you want, you can only put one instrument in there, right? In my case, for example, I like to invest in the S&P 500 ETF. Again, not investing advice, just sharing what I'm doing. And you can choose any of those from London Stock Exchange, which would be in dollars, or Euro ones in Germany, Or of course, I think that's also in dollars from the Swiss exchange. But in my case, I would want to buy the distributing S&P 500 ETF in dollars in London. So again, you can pick any of those, go ahead, select it, go further. And from here, you could either add other instruments. If, for example, you want to have 80% of S&P and maybe 20% of an individual share, maybe something more risky, like, Tesla or whatever it is, you can add that. Or if you only want that over here, leave it in here. You can see minimum investment, only $1. Amazing. Really, really cool. In this case, 100% of the investment goes into that single ETF. Click on next. And here, that's the beauty. You can either have auto invest or manually. But of course, as I said, you want to have auto invest. So it's done on your behalf. That's basically dollar cost averaging. Click on next. It kind of gives you some projections. We run our own numbers, so I don't need it. And then from here, you can choose the distributions. If there was to be any dividends, whether you want to self-balance or by target. But in this case, it doesn't really matter because obviously we only have one ETF in there. And then you can say how much is your initial deposit. And then you can also choose your investing period, right? Whether you want to invest monthly, every 2 months. I really wouldn't recommend you every 6 months or 2 months. Monthly at the very least. In my case, I do weekly. It's up to you. I just think you get a better average price over time than monthly, right? Because on that specific day of the month, whenever you set it up, right, and you can choose the day of the month, whether it's the 1st, the 15th, whenever you get paid, maybe do it a few days after you get paid so you have enough money in your account. So it's up to you, really. I just like weekly because I get a better average price over time because sometimes I'll buy slightly higher, sometimes slightly lower, and monthly, the average is a little bit less, right? Imagine yearly on the other extreme, you would only get once a year. So hopefully at that time, the price is low. But if it's a high day on that day when you buy, well, then you're obviously going to pay premium, right? So, but ultimately between monthly and weekly, it's a personal choice. However, do keep in mind, if you choose monthly and you're not going with trading 2-on-2, which is totally fine, right? There are some other great brokers out there that I use myself, for example, eToro, or of course, interactive brokers, you will pay a commission. So if you invest very little, let's say 100 euros or dollars, and you pay $1, $1.50, $2, depending on which broker you use, let's say 2% on $2, right? That's a high percentage for commission. So in this case, if you're really stuck on that broker anyways, which is fine, right? Long term, you still want to go with interactive brokers maybe, because it's very easy to move to different countries. It has a lot of benefits, and I made a lot of videos about this, so I don't want to elaborate on this video. But in this case, I would probably want to recommend you to go with monthly, because otherwise you would pay that $2 every single week, and those fees do add up. Now, if you invest, I don't know, 5,000 euros a month, then obviously, $2 or €2, they don't really make a difference, right? So it really depends on your personal situation. As I said, if you're starting off on a small amount, then I would definitely recommend you to use trading 2-on-2. Even if you do daily, for example, you wouldn't pay any fees, which is really awesome. Set it up. You can choose the day. Definitely make sure to use a working day because that's when the stock market is open. You can buy after hours, but usually the spread is not ideal. And yeah, I would just recommend you to buy during the market hours that are operating. Click on update. You can even set it up for 40 years. Really crazy. And then go ahead next. Go ahead, give it a name. Call it the yacht portfolio or private jet portfolio, whatever it is, just to identify what it is. Or even for your children, you can give it a name. So whatever it is. And then click on next. And then you get a little summary of what it is. And then obviously you need to fund the pie. Basically, make sure you have money in your account. So once you have that money in your account, it will basically start triggering that order. And from here, the cool thing is you just go into the bank where you receive your salary or your business money into and set up a recurring transfer into trading 2-on-2. So let's say every month you send a certain amount of cash from your bank into trading 2-on-2. And the cool thing is once the money is there, you can even earn interest on trading 2-on-2 with this. And in this case, every Wednesday, it would take that money and invest it into the stock. So it's literally automated. So you don't have to think about anything anymore. Automatically, the money sends from your bank into trading 2-on-2, and trading 2-on-2 automatically invests it into your chosen investment vehicle. Really perfect. And I think that's, for most people, probably the best strategy that I could recommend. Really investing on autopilot. So you don't have to think about it, whether you feel like it or you had a busy day. Those investments will get done. And that way, even if the market goes down, you don't have to worry about whether to invest or not. It will just continue averaging down, which will be in your favor, right? If the market picks up, well, then you keep on buying at higher prices. That's totally fine as well. Just to give you an example, in one of my brokers that I have as well on eToro, where, by the way, you can also now set up recurring buys to automate the investments. On Amazon, for example, I started a position not so long ago. You can see the price points when I bought. The first time I bought at $214, then at $209, $197. So up and down. But I also bought at $209, right? And all those positions, you can see my P&L. On some of them, I'm up $24. Some of them, I'm up $166, right? So I kept on dollar cost averaging and we will still continue to buy. Even now at $225, I'll still buy because in the future, I think the stock will be even higher. Again, not investing advice. That's just, my conviction in that stock. But you can see, obviously, I also have my S&P 500 holding over here, or I'm also in the plus. So that's just the beauty of setting up dollar cost averaging, which I really recommend for most people. It just automates it and takes out the guesswork and the extra work of having to log in, and just takes out the friction and avoids that you skip a week or two. It's just like a workout. You want to do things habitually rather than once in a while whenever you feel like it. But what about you? Are you team dollar cost averaging or lump sum investing, trying to outsmart the market? Let me know in the comments down below. Happy to hear from you. Next up, check out this video here. As always, thanks for watching. Stay healthy, get wealthy. See you in the next one. Ciao.